Hello friends, welcome to a lecture series on financial management. In today's discussion of mine, I'll be telling you about the Treasury Management and Control. This is the part 6 of our lecture series on Treasury Management and Control. In today's lecture, I'll be telling you about the optimum level of cash balance. Because we have already discussed in previous lecture of ours what are the different components of Treasury Management and Control. The planning aspect we have discussed, we understood how to prepare cash budget, and we also did the controlling and review aspect of this particular Treasury Management and Control. So in today's lecture I'll discuss with you about the optimum balance of cash, optimum cash balance or optimum treasury balance. There are two different models which are very popular in this particular topic. One is the Baumol's model of cash management and the second is Miller-Orr model. So I'll be explaining to you about the different components or different takeaways of these two important models, and eventually we'll talk about the different functions of treasury manager and what is the organizational setup for treasury management and control. So let's start with the concept of optimum cash balance. There are two basic models into this which are known as Baumol's model of cash management and Miller-Orr model. The cash budget of a firm may indicate the period in which the firm may have a shortage or surplus of funds. So cash budget is actually giving you a kind of idea that at which point of time you'll be either having shortage or surplus of funds. So it is giving you the idea about the cash planning or the anticipated cash. In case of expected shortage of funds, the firm may think of ways and means to overcome it. Suppose if there is some shortage, company can go for applying some other alternatives. Company can go for taking loan from the banks or from some other institutions, suppose if the shortage is there. But what if the balance is exactly equal to the planning or the anticipated value? If that is equal to it, then there is no problem. It means your planning is exactly the going as per your anticipation. Your anticipation is going as per the actual value, so there is no problem. It means your planning is the excellent. Your planning part is excellent. You have properly anticipated the cash requirement. But what if there is a shortage? If shortage is there, obviously you'll have to find out the ways and means, and for that we need to be prepared in advance. It's not like that at that point of time, suppose if some deficit is there, we'll be going to the banker and applying for this particular loan. No, we'll have to have some prior arrangements for this particular shortfall. If there is a shortfall, what is plan B, what is my alternative action, that should be decided. So alternative course of action is already decided. But suppose if there is a surplus, the company may explore the profitable options for parking the surplus funds. We have to actually park that particular surplus fund because that fund is no more required into our business. It is not required into the business, and this fund has certain cost. So we have to find out the profitable avenues for parking this particular investment. But remember, before investing surplus into marketable securities, the firm must determine the optimum level of cash balances for the firm. You cannot take your decision like this, that we have a surplus, we are going for investing it into some profitable avenues. We have to find out that what is the optimum level of cash for this particular firm in which we are making this particular decision. But remember, the problem of determining optimum cash balance for a firm implies a trade-off between the risk and return in maintaining cash balance. There is a risk also and there is a return issue also. We have to find out fine balance between the risk and return, which is known as risk return trade-off here in maintaining the cash balance. There are several models which deal with the problem of optimum cash balance, but two very important of them are Baumol's model of cash management and Miller-Orr model, which I am going to discuss in today's lecture. So let's start with the Baumol's model of cash management. This particular model was given by W.J. Baumol in 1952. And this model of cash management is the same as the economic order quantity model of inventory management. Just like we have been doing the calculation of EOQ into inventory management process, the same is the process of this particular Baumol's model of cash management, where we try to find out the optimum level of cash. The very assumption of this particular model given by W.J. Baumol is that the firm uses cash at an already known rate. This is the assumption, that firm is using the cash at an already known rate, which means the rate of that particular cash, the cost of that particular cash which we are using into a firm, that rate is known, and this rate of use is constant. So rate is already known to us, it is priorly known to us, and second is this particular rate, whatever is known to us, is going to be constant. Which means the moment I am saying rate is going to be constant, it means this particular model is having short term relevance only, because constant rate can only be in short run. In long run, obviously all the rates are going to change. Rates are subject to change. So this is the very assumption of this particular model. This model talks about two important cost of this particular cash. One is the cost of holding cash. The second is transaction cost. When we talk about holding cost, this model says that there is always a cost of holding cash by a firm. If you are holding cash into your business, obviously this cash is having certain amount of cost. This cost may be the opportunity cost of cash foregone by the firm, usually interest on cash. Suppose if you have taken loan from the bank, obviously that interest on loan is going to be your cost. Suppose if you have not taken any bank loan, then obviously the opportunity cost of cash which you have foregone for this particular purpose, for keeping it into your business, which is usually known as interest on that particular capital or cash which we are using. So if you are holding cash into your business, there is some holding cost which you have understood. Obviously it is interest on that particular cash. The second is transaction cost. Suppose if you have surplus cash, you have an opportunity to convert it into marketable securities. Suppose if deficit is there, then you have to go for the reverse exercise. You have to convert your marketable securities into cash. So whenever the cash is converted into marketable securities or vice versa, there is always a cost involved in the form of brokerage, commission, etc. There can be some cost. There is going to be some cost the moment you are going to convert your marketable securities into cash. So if it is converted into cash, or if you are going to invest into this marketable securities in case of surplus fund, there is always a cost involved in the form of brokerage, commission, or there can be some other name for this particular cost, but that is known as transaction cost, which means that while transacting with the marketable securities, obviously there is some cost that is known as transaction cost. It is just like in case of inventory, the holding cost is the same, like there it was basically the carrying cost, and transaction cost is here. What we call transaction cost, that was actually there we were talking about carrying cost and ordering cost. So that was actually a kind of ordering cost into inventory management. But here for cash management, Bamul talked about two important costs. One is holding cost and the other is transaction cost. And it said that this model is based on the proposition that in order to reduce the holding cost, a firm has to keep the least amount of cash in hand, because we have to reduce the holding cost. And the level of along with the level of cash, however, as the level of cash depletes, the firm can acquire cash by selling some of its marketable securities. It says that whenever you have some deficit of cash, you can convert your marketable securities into cash, you can sell them out, and obviously that is going to involve certain amount of transaction cost. Each time the firm transacts this way, if you are going to convert your marketable securities into cash, this is going to bear some transaction cost, so it will avoid frequent transactions. So to ensure that the transaction cost is minimum, the company is going to make less number of transactions, and this can only be done by maintaining a higher level of cash involving a high holding cost. So you are actually running on the edge. If you are increasing your holding of cash, there is a cost of capital. If you are increasing your investment into marketable securities, there is going to be a cost of transaction. So either way you are going to incur certain amount of cost. So we have to find out a fine balance between these two costs. We have to somehow find out a point where these two costs are minimum, and that point is going to be your optimum level of cash balance. Just like in EOQ we were trying to find out a point of intersection between the carrying cost and ordering cost, here too we'll try to find out the minimum point of the point where both the costs are minimum, that is transaction cost and holding cost, they are at their minimum, so that the total cost is minimum. So the firm has to deal with the holding cost as well as the transaction cost, and the optimum cash balance is found by controlling the holding cost and transaction cost so as to minimize the total cost of holding cash. As far as the formula is concerned, Bamul came up with the formula like this: under root 2 FT divided by R, where the C stands for cash required each time to restore balance to minimum cash. This is what Bamul gave into his model, that C, we have to compute the amount of C, that is cash required each time to restore balance to minimum cash. F stands for total cash required during the year, T stands for transaction cost, and R stands for rate of interest on marketable securities or holding cost. Just like the formula of EOQ, where we had a formula like under root 2 AO divided by C, that is ordering cost divided by carrying cost. Here also we have under root 2 FT divided by R, where the F is total cash required during the year, T is transaction cost, and R is rate of interest on marketable securities or holding cost. Now the question comes how to understand it graphically. If you look at this particular graph of optimum balance of cash, the transaction cost, the curve of transaction cost is like demand curve sloping downward from left to right, because it declines with the increase of cash balance. Because if you increase the amount of cash which you are going to convert into marketable securities, then obviously number of transactions will be less. So if number of transactions are less, obviously the cost is going to decline. So that is why it is sloping downward from left to right. Suppose if you are reducing the transaction, the cost is going to increase. On x-axis we have shown the cash balance, on y-axis we have shown the cost. So transaction cost is going to have a curve like demand curve, and the holding cost is going to have a curve like supply curve, where it increases with the increase in quantum of cash. So greater the amount held by the company, the higher will be the cost of holding. That is why it is increasing, and it starts from zero. If there is no holding of cash into the business, the cost is zero. And the point of intersection, which is indicated by E, is actually the point where both the costs are minimum, where both the costs are minimum. And if you look at the total cost of this particular maintaining cash balance will also be minimum. So this point of E, which is telling us about the quantity of cash balance by OQ star, this is going to be our optimum balance of cash. This is actually my optimum balance of cash if we try to represent it graphically. So in this way, what we have done, we have actually tried to find out a point where both the costs are minimum, so that the total cost of maintaining cash is minimum, and that will actually tell us about the optimum balance of cash. So the point of intersection is going to tell us the minimum cost and the minimum cash balance which the firm is supposed to maintain apart from the safety level of cash. Remember, it is suggesting you that you have to maintain, might be possible that your actual requirement is less than this optimum balance of cash, but this is going to ensure the minimum total cost for this particular maintenance of cash, because holding cost and transaction cost both are minimum. Now let's try to understand it numerically, what Bamol wanted to say with a very small numerical example. Suppose there is a company called Nupes Limited. Nupes Limited has a total cash requirement of rupees 5 lakh per annum, and this company is having a rate of interest of 15% for every transaction of marketable securities. It is saying that the rate of interest is 15%, and for every transaction of marketable securities, this particular firm has to pay rupees 25. And they are asking you to calculate the optimum cash requirement of Nupes Limited as per Bamol's model. So let's try to help this particular company by computing the optimum level of cash as per Bamol's model. As I told you about the formula given by Bamol's model, that cash requirement is equal to under root 2 FT divided by R. We understood 2 is numeric 2, 25 rupees is the transaction cost given, 5 lakh rupees is the total cash requirement, and we have divided it by the rate of interest, that was 15% for Nupes Limited. And once we calculate, the cash requirement comes to be rupees 12,910. So in this way, with the Bamol's model, by simply putting the value into the formula, we can find out the optimum balance of cash. But Bamol's model is having certain assumptions which we have discussed at the very outset, and those assumptions basically becomes a limitation of this particular model, and that is why we needed some other improved model, improvised model for this particular optimum balance of cash. Now what are the limitations of Bamol's model of cash? Let's try to understand. It assumes the constant rate of use of cash, which is not practical. Practically speaking, we cannot have the constant rate of use of cash into our business. There is no guarantee of it. It depends solely or totally on the the kind of customers we are having, the type of demand we have in the market. It depends on that. So we cannot have a constant rate of use of cash, which the Bamol's model unfortunately took as an assumption. Generally, the cash outflow in any firm are not regular, hence it may not give correct results. So whatever formula Bamol has given, it can theoretically be very lucrative, that you are finding a point where the the transaction cost and the holding cost, they are the minimum, and that is why we are trying to ensure the total effective cost of maintaining cash is minimum, so we can find out the optimum balance of cash. But in reality, what happens? The cash outflow in any firm are not regular. It might be possible that today the cash outflow is very high, in next month the cash outflow is nil, or there is no payment, there is no due date, there is no payment due for my suppliers. So obviously this particular model is not going to give us the correct results. Next is measuring the transaction cost will also be difficult, as it depends upon the type of investment as well as the period of maturity. So it depends what kind of investment you have, what is the type of investment you have resorted to, and what is the period of maturity. Suppose if period of maturity is high, obviously, and you are going to withdraw, you are going to take the prematured that particular withdrawal of that amount, obviously that particular company or authority is going to impose some penalty onto you. So measuring the transaction cost will actually be very, very difficult in practical life. In spite of these limitations, this model has a theoretical value. You must be thinking that, sir, you told us about the model, you gave us assumptions, and now you are saying it has so many limitations. But remember, my dear students, in spite of all these limitations, this model has a greater theoretical value. It is actually telling you that this can be a possible situation. Suppose if you can anticipate the carrying cost, the holding cost of your cash along with the transaction cost with certainty, you can very well find out the optimum balance of cash. And that will actually be a point, that optimum level of cash will actually be a point where your total cost of holding cash is going to be minimum. So that is what is the benefit, or that is what is the idea which this Baumol's model of cash management tried to put in front of us. So this model is actually having a theoretical relevance just like EOQ model. So in case the firm is in a position to anticipate the transaction cost and the holding cost with certainty or with some amount of certainty, obviously this model is of great help to us. We can very well identify that this will be my optimum level of cash, and since it is giving us the exact value, exact amount of cash which we have to maintain, it is of great help to us. Even if suppose if these things are changing, we can have some value, we can have investment of, we can have a maintenance of optimum balance of cash, along with that we can have some arrangements with our bankers, so that in case of any untoward incident, we are not into the situation of embarrassment. We can actually find out a way where we can minimize our cost. So we have to understand that this model is giving us an idea as to how the holding cost and transaction cost should be optimized by the firm, and at that point only the cash whatever is required will be the optimum level of cash required by us. Now the next very important model into this series is Miller-Orr model. Miller-Orr model was actually given by Miller and Orr in 1966. Remember, Baumol's model was given in 1952, and this Miller-Orr model came into 1966. So roughly 14 years after this particular Baumol's model, we got this Miller and Orr model, and it actually expanded the Baumol's model, which was not applicable in certain situations. Baumol's model was having certain limitations. So this model, what it did, it actually expanded what Baumol said. Whatever Baumol's model said, it actually provides some expansion to that particular model, and it said that the Baumol model was not applicable in case the demand for cash is not steady. Suppose if the demand for cash is not steady, Baumol's model cannot be applied. As per this model, in case uncertainty over cash flow is very much high or very large, the inventory type model cannot be used. And obviously they are right also into their approach, that if there is a greater uncertainty over cash flows, and the amount is involved is very high, then obviously inventory type model or EOQ type model cannot be used, which was actually given by or proposed by the Baumol's model. It says that this model is giving some argument, and that argument is that the changes in cash, the changes in cash balance over a given period are random in size as well as in direction. So they are saying the change in cash is very much random in size as well as in direction. So there is a random change, you can't anticipate. So in that situation, the cash balance of a firm may fluctuate irregularly over a period of time. Cause of this random fluctuation into the size and direction of cash, what will happen? The cash is going to fluctuate across the that particular period for which we are doing the computation. So cause of that only, the Baumol's model cannot be applied into those situations where the cash is fluctuating very much, and for that this Miller-Orr model is a solution. Miller-Orr model is coming out of that EOQ model, and it is talking about some practical solution to this problem of fluctuating cash balances within the organization. It gives a very viable solution with certain assumptions that we are going to discuss. It talks about the return point. It talks about the higher level and lower level. It says that we should try to find out some higher limits and some lower limits, and then a return point. What is a return point? Return point is a mid level. It says that in case the cash is very much high beyond return point, the level of cash is very high, then it should be invested into some marketable securities, some profitable avenues, so that the actual cash balance comes to the return point. And suppose if your cash balance is on the lower side, then you should try to infuse more amount of cash into your business, so that the cash level comes to the RP, that is return point, so that we have an optimum level of cash. So it is actually giving you a very good idea about the higher limit, maintaining the higher limit and lower limit, and it suggests that your cash need to flow within these two limits, the higher limit and the lower limit. And the return point is actually acting as a mediator, as a midpoint, or you can say it is acting as an alarm that whatever surplus cash we have, we are not maintaining the lower limit of cash only. Lower limit is always supposed to be kept into our business. That is a safety level. But we need to maintain sufficient amount of cash which is greater than, which is much ahead of our lower limit of cash or safety level of cash. So that is a return point that is given by, that is moderated by the return point. So I hope you must have understood what exactly they wanted to say. So they were trying to say that cash must be allowed to float between these two limits. So within these two limits, if the cash is flowing, it is good. But the moment return point comes, you need to understand below return point will never let the cash go down. So we have to understand this, and beyond RP also, beyond return point also, will not let the cash go. If cash is above RP, return point, obviously we'll have to invest it somewhere. If cash is below RP, we have to infuse more amount of cash into our business. So let's understand what was the assumption. With this understanding of basics of this particular model called Miller and Orr model, let's discuss about the assumptions of this particular model. This model says that out of the two assets, that is cash and marketable securities, the latter has a marginal yield. The marketable security has a marginal yield, but yield is there. And the second is transfer of cash to marketable securities and vice versa is possible without any delay, but of course at some cost. It says that transaction cost, it actually accepted and endorsed the presence of the transaction cost, just like Baumol's model proposed. It says that we cannot deny to the presence of the cost of converting your cash into marketable securities or vice versa. That cost is there. But remember that along with that cost, there is some marginal yield. The yield is marginal, but there is some yield into our marketable securities. And in this background, it says that the model is giving you a specification that two control limits for cash balance. It is specifying two control limits for cash balance, as I told you previously. An upper limit which is denoted by H, beyond which cash balance need not be allowed to go. So we have to find out, it proposes an upper limit of cash which is denoted by H, beyond which cash balance need not to be allowed to go, and a lower limit which is indicated by L, below which the cash level is not allowed to reduce. And they wanted to say that the cash balance should be allowed to move within these limits. So within H and L, you are supposed to permit the flow of cash. This is what this model wanted to propose. This is what this model tries to explain. It says that if the cash level reaches the upper limit, that is H, then a part of cash should be invested in marketable securities in such a way that the cash balance comes down to a predetermined level which is known as R, or which is known as return point. So if you have surplus fund, you invest it, but you have to ensure that your cash availability should not go below the level of return level, that is R. And for that they have given a formula how to calculate return level. And on the contrary, when the cash balance reaches the lower level, that is L, then sufficient marketable securities should be sold out to realize cash so that the cash balance is restored to the return level. This is what we have to do. If the shortage of cash is there, we have to understand, we have to ensure in any case that the return point should be maintained. The cash must be maintained equivalent to the point of return which is indicated by R. And no transaction between cash and marketable securities undertaken as long as the cash balance is between the two limits of H and L. So we are not going to convert our cash into marketable securities or vice versa unless the cash is floating between H and L. So for this particular concept, they have given a formula for computing RP, that is return point. It says that cube root 3 BV divided by 4I plus LL. This is what the formula given by Miller-Orr model. It says that RP stands for return point, B stands for fixed cost per order of converting marketable securities into cash. So per order of converting marketable securities into cash, whatever fixed cost you are incurring, that is indicated by B. V stands for variance of daily changes in the expected cash balance. My dear students, remember, V is actually representing the variance of daily changes in the expected cash balance. So expected cash balance for a day is given, and into that we have to find out the daily variances. I stands for daily interest rate earned on investments, and LL is actually your lower control limit. So with this abbreviation of this formula, that is cube root 3 BV divided by 4I plus LL, we can calculate the point of return, or you can say return point, which is indicated by R into this particular Miller-Orr model. This model says that you can calculate a return point. Suppose if you wish to calculate the upper limit with the help of return point, it is very simple. Just like we were calculating mode with the help of mean and median, 3 median minus 2x bar. For mode we were calculating z is equal to 3m minus 2x bar. Here also we have a formula for upper limit of cash, that is 3 rp minus 2 ll, where rp stands for return point and ll stands for lower limit, and UL is actually indicating the upper limit. So with the help of Miller's model, Miller-Orr model, we can actually calculate the range of cash, the two different you can say the two different ranges of cash which is to be maintained. One is indicated by L, the other is indicated by H, and we have to find a return point. And in this way we can very well maintain the optimum level of cash into our business even when the cash is very much fluctuating. This model, remember my dear student, it has a superiority over Baumol's model because it is more realistic due to the assumption. So cause of this assumption, it is very much realistic that cash balance may fluctuate between the higher and the lower limit. This is what this model wanted to say. So in today's lecture, what I tried to make you understand, I actually tried to explain you the concept of optimum balance of cash, in which we discussed about the Baumol's model of cash management, which was just like EOQ model of inventory management. The second was Miller-Orr model, which actually expanded the concept given by the Baumol's model, where Baumol's model talked about the EOQ model of this particular cash management or maintaining optimum balance of cash. This Miller-Orr model gave us the two ranges of L and H, and also gave a concept of return point, which is very much realistic also. I hope you must have understood this particular concept of Baumol's model of cash management and Miller-Orr model of cash management or maintaining optimum cash balances. In next lecture of mine, I'll tell you about how to manage marketable securities. What are the different components of marketable securities, how to invest into that, point number 1. And second, I'll be telling you the way this treasury management and control is executed within the organization, although the organizational chart can be different for different organizations. But still, just to provide you an understanding, the kind of treasury management and control is being executed into modern business houses, I'll give you an idea. I'll try to give you some idea about that particular function of treasury manager and controlling process. I hope you must have understood today's concept of Baumol's model of cash management and Miller-Orr model of cash management. Thank you so much.